Are we heading for a property market crash? In this short video, I'm going to share with you my thoughts on the current state of the market and whether we have a crash coming. Hi, my name's Mark Lloyd. I'm co-founder of Property Master Academy and I've been investing in property since 2005. So, are we heading for that property market crash? Well, this is a topic of conversation amongst many investors on online forums at the moment. Can the current market continue? Well, here's my thoughts and why I think there is still some mileage left. Now, I've lost count of the number of times over the past decade when someone has said that there's going to be a crash, and yet here we are. Of course, we can always rely on the newspapers to provide the doom and gloom. Now, don't get me wrong, there will be a crash, but I don't think it will be just yet. But bear in mind, there are always crashes and market blips, so it's nothing to worry about if you follow some simple rules. In some circles, it's being argued that London and the South East are substantially overpriced because of the ratio between house prices and salaries, and consequently prices must fall. Well, I don't think so. Prices change due to an imbalance of supply and demand caused by two main factors. Firstly, actual factors such as interest rate rises or other costs associated with home ownership. And secondly, fear created by the prospect that house prices might crash or fear of a recession. Now, this has happened previously. In the 90s, when there was double-digit interest rates and the market fell by over 20% on average, and in 2008, with the credit crunch caused by the failure of some financial institutions, which caused a similar average price drop, although some areas more than others. There is also this theory called the 18-year property cycle, which was devised by a British economist, where he correctly predicted both crashes and extrapolated it through history to confirm other crashes as well. So, by the way, if you're liking this content, then please hit the like button and subscribe to our channel. So the first question you should consider is whether we are in a property bubble. Well, I don't think we are. Why? Because in previous crashes, prices have risen substantially. In 1989 by circa 30% and in 2007 by 16%. Now, I know it may seem like prices are increasing rapidly at the moment, but let's take a closer look. If you look at the standard indices from Land Registry, Halifax and Nationwide, then it would appear that we are in a bubble. But if we look at the reasons for this, it is mainly due to the change in mix of sales for houses versus flats. Now, if you look at the Zoopla index, which takes these factors into account, then prices rose by 4.2% in 2020 and 7.4% in 2021, a far cry from the double-digit growth mentioned by the others. This would also seem to bear out where we are in the 18-year cycle, if of course you accept that theory. Now, in addition, most regions of the UK, except London and the South East, have shown price rises since 2005, far less than inflation. And the recent rises are just these areas catching up, with parts of the North East only 7% above the 2008 pre-crash levels. So how does all this look with the 18-year cycle? Well, from when the last crash started in 2008, we had a period of approximately 4 years where house prices declined. The next 7 years were the recovery period where prices started to increase, but in most areas did not exceed the pre-2008 levels. Then for the next couple of years, there was a slight correction, as happened in London, parts of the South East most definitely, before we then reach the boom phase, which can last for 4 to 5 years, where prices will far exceed the pre-2008 crash levels, so that we're at a new market high, well above the 2008 prices. So how does this relate to the present day? Well, if we take the first 4 years from 2008, that brings us to 2012. The next 7 years, recovery years, bring us to 2019. We then had a couple of years of correction, bringing us to 2021, which means we are now in the boom years until at least 2026. Now, whether you believe in the 18-year cycle or not, take a look at what is different between now and the last boom and crash. Firstly, the last crash was failure in the financial sector. Now, all banks have strengthened their balance sheets since then at the direction of their national banks. Secondly, we've had quantitative easing, and the pandemic has pumped billions into the UK economy. Where does it all go? Traditionally, property. Next, we've got the structure of the housing market has changed. Over 50% of homeowners are mortgage free, so are not affected by interest rates, and another 20% of homeowners are rented. The levels of borrowing are not as high as at the time of the last crash. All new residential mortgages since 2014 are now repayment mortgages, with a notional affordability rate of circa 5%, which is way above the current level of mortgage rates, which means the amount that can be lent based on salary has been capped. Now, this in part means that most of the reasons for repossessions, for example, in the last crash have been removed. So are we heading for a crash? Well, as an investor, you should only be concerned with just two prices: the price when you buy and the price when you sell. Everything in between is just noise. Remember, property investing is about the long term, not short term market fluctuations. We still do not have enough properties in the UK, and although the past couple of years appear to have given high growth rates, the reality is that the growth was just catching up, and I fully expect the rate of growth to reduce to pre-pandemic levels by the end of 2022. Well, that's my opinion. And you know what? Opinions are like belly buttons. Everyone's got one. So I hope you found this video useful. And if you have, please hit that like button so other people like you can benefit, and also subscribe to our channel so you get notified when other videos are published. Appearing on your screen right now are more videos that will help you in your property adventure. Thanks for listening.